So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, what's the difference between volume and volatility? So this is another member question. Somebody sent me a question. Basically, it was this. It was, some places are saying that if a stock has high volume, then it might also have high volatility. Or I see that people are mentioning that a stock is moving really high in volume and volatility, but can it really be both? So what's the difference between volume and volatility? So the simple answer to this is that volume tells you how much of something is being traded. So volume in the sense of either stocks or options tells you how much of that stock or option contract is being traded. If there's a lot of volume, that means that there's a lot of trading that's occurring. There's a spike in trading activity. Now, this doesn't always mean anything for direction. A high spike in volume for call options could be a hedge and doesn't necessarily mean that somebody is expecting the stock to make a big move higher. But all we know is that there's a lot of volume that's now coming into the market. There's a lot of activity in the market. On the other hand, volatility tells us how much expected volatility or actual volatility the contracts themselves are seeing that day. So if we have, for example, a stock that is making huge moves during the day, it's up $10, then down $20, then back up $10, that's a lot of volatility for that stock price. Now, the stock could also have high volume for that day, meaning that in addition to the huge swings that's having in the price, it's also a record-breaking day for the number of people who are trading contracts. And that most of the time is the case. When you have a lot of volume, it's also followed by a lot of high volatility. In the world of options, what we typically associate with volatility is implied volatility or expected volatility. So you could have a stock that has a lot of volume, or option contracts that have a lot of volume. People are expecting the options to behave or move in a certain fashion in the future. And that increases the volume or number of people who are trading, but it also increases the expected volatility of the stock. Now, this doesn't mean that the stock actually is going to make a move. We see this a lot with earnings trades, where right before a stock announces earnings, the option contracts have huge volume. Lots of people are trading them. The stock is not moving, however, but implied volatility, the expectation of a move in the actual option contracts, is being bid up. People are expecting a big move at some point in the future. It just hasn't happened yet. So understanding these two differences, I think, is obviously important, and it definitely helps you decipher what people are trying to say online. If you're reading a forum post or somebody's article or their tweet about volume and volatility, just really understand what they're kind of talking about and what that means in the grand scheme of options trading. As always, hopefully this helps out. If you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.